The closing bell rang 15 minutes ago. And if you're just glancing at the final print for Friday, June 12th, 2026, the tape looks perfectly serene.
Right, yeah, green across the board.
Exactly. The scoreboard shows the S&P 500 gaining 0.5%, getting that closing print at 7,431.46. The Dow, the DIA added 0.70%, and the NDX, the tech-heavy NASDAQ, it edged up 0.31%.
Which, I mean, on paper, that is a textbook risk-on session.
Yeah, sealing the S&P's 10th winning week in the last 11, it looks like a market just cruising on autopilot.
It does, but, the institutional reports we pulled for this deep dive tell a completely different story.
Oh, entirely.
Underneath that calm green surface, Friday was, it was just a session of violent rotation.
Just algorithmic chaos.
Yeah, exactly. You had a market balancing on the razor's edge of global geopolitics, while simultaneously trying to digest the sheer gravitational pull of the largest IPO in human history.
Okay, let's unpack this. Because the narrative here, the journey to that green closing print, was a massive head fake.
A total head fake.
The morning started with a geopolitical shockwave out of the Middle East. Walk us through how the trading algorithms process that out of the gate.
So, early in the pre-market, headlines hit the terminals that President Trump called off planned overnight strikes on Iran.
Right.
But it escalated past, simply avoiding a strike. News broke that a formal U.S. Iran peace deal memorandum was, that it was imminent.
With talks of it being signed in Switzerland this Sunday, right?
Exactly. And the critical data point for the market was the potential reopening of the Strait of Hormuz for global energy trade.
Which is, the single most vital artery for the global oil supply. And just to be clear for you listening, when we look at these events in this deep dive, we are looking at them strictly through the cold, impartial lens of the market's plumbing.
Right. There is no political endorsement here whatsoever.
To the algorithms, a peace treaty isn't a moral victory, it's just a macro input.
It's just data. The market is a dispassionate, calculating machine. And the immediate calculation was simple. Less geopolitical friction means fewer supply chain disruptions.
Right, so what happened to crude?
Instantly, the price of Brent crude oil tumbled 3.4%, down to $87.33.
Wow.
And a rapid drop like that, it functionally acts like a massive tax cut for the broader consumer economy. It lowers input costs for corporations.
Cuts transportation costs for logistics companies.
Exactly. So traders bought that headline aggressively. They crushed the VIX and sent the broader market surging in the morning.
And here's the key reversal. The narrative flipped violently. Midday, Tehran issued a statement denying that any formal framework for a peace deal had actually been approved.
Yeah, the entire risk profile of the weekend changed in a heartbeat.
So look at the internals for us. Did the real money, the institutional capital, actually buy this closing rally we saw on the scoreboard?
Not at all. What's fascinating here is they were absolutely using that morning retail optimism as exit liquidity.
You always have to look for volume confirmation, right?
Exactly. But the smart money is confident. You see heavy volume pushing the market up and sustaining it. But on Friday, the SPY only traded 54.9 million shares.
Wait, 54.9? That's way below average.
Yeah, the 30-day average is about 60.9 million. So broad market conviction was practically non-existent.
It was worse than non-existent. I mean, they were actively de-risking into the close.
Oh, completely. In the final 90 minutes of trading, as the major indices were, printing green, the big block trades were actually sell orders. They were fading the rally.
Because nobody with fiduciary responsibility wants to hold massive, unhedged, long positions going into a weekend with a highly uncertain Swiss peace meeting.
Right. And don't forget, next week brings a highly anticipated FOMC meeting.
Oh, right. And it's not just a standard rate check. It's the first one under the new Fed chair, Kevin Warsh.
Exactly. When you have a binary macro event like that, institutional risk models force portfolio managers to just pull their chips off the table.
You don't guess the outcome, you reduce exposure.
Yeah.
So if the broad index volume was that light and institutions were actively pulling capital out into the close, that creates a massive vacuum. The money had to be flowing somewhere. And that brings us to the single ticker that basically swallowed the market whole on Friday, the SpaceX IPO, ticker SPCX.
The defining liquidity event of the session.
The numbers here are just staggering. Largest IPO in global history. It raised $75 billion.
Incredible.
Priced at $135 a share. It opened for trading at $150, peaked intraday near $176.52, and finally settled at $160.95.
That's a 19.2% gain on day one.
Officially propelling Elon Musk into trillionaire status, But it's the volume that is truly wild.
Right, the sheer amount of shares exchanging hands.
SPCX traded 414 million shares on day one. It nearly broke Meta's all-time single-day trading record.
Which is insane. When a $2 trillion entity goes public, it doesn't just list on an exchange, it actually alters the market center of gravity.
Yeah, that kind of volume requires an ocean of capital.
But that capital doesn't just magically materialize. You
Ow.
can't introduce a sponge that massive without draining the water from somewhere else.
Right. So where did the money come from?
The institutional reports are calling this the space stock shakeout.
Okay.
Portfolio managers often have strict mandates. They have to hold a certain percentage of their funds in aerospace and communication sectors.
Sure.
And suddenly, there's this absolute behemoth in the space that they are practically required to own to benchmark properly.
So they liquidate the proxies' satellite competitors.
Exactly. Leading up to this IPO, retail traders had been heavily bidding up those alternative space stocks, thinking, a rising tide lifts all boats.
If the market is excited about space, every space company will run, but correlation does not equal participation.
And that is the harsh reality of market liquidity. The smart money aggressively pulled their cash out of the smaller players to rotate it directly into SPCX.
The sector peers didn't benefit from the IPO at all. They became the funding mechanism for it.
Yeah, they were used as an ATM.
The hard numbers are brutal. AST SpaceMobile, ticker ASTS, crashed 15.53%, down to $82.41.
And EchoStar, SAT, plunged 10.9% to $114.16.
It's like watching a newly formed supermassive black hole violently pull in all the capital from the surrounding planets.
It really is. But the liquidity drain didn't stop at the aerospace sector. To fund a $75 billion allocation, you have to sell the most liquid assets you own.
Right, which takes us to the broader market breadth. Here's where it gets really interesting.
Yeah, because the narrative really diverges from the surface numbers here.
You would assume on a day where a tech darling like SpaceX is making global history, the tech sector would be carrying the broader market. But this was definitively not a big tech rally.
No, big tech was actually the anchor weighing the indices down.
Wow.
Capital violently rotated out of the heavyweights. Apple, Microsoft, Broadcom, Meta, they all faced significant institutional selling pressure.
Yet despite those giants pulling back, over 62.4% of U.S. equities advanced on Friday.
Right. So while they were selling the tech giants to buy the new space giant, money was quietly rotating into the real economy.
Value and cyclical plays took over. Basic materials led the charge with a 1.87% gain.
And the small cap index, the Russell 2000, outperformed the big indices with a 0.8% jump.
So a very healthy, broad-based catch-up in those cyclical sectors.
Yes, but the sources also flagged a massive, glaring warning sign hidden in this rotation.
What's that?
The real estate sector ETF, ticker XLRE, hit a brand new 52-week high.
Wait, hold on. Why are investors hiding in real estate if the market is hitting highs? I mean, that is historically a slow-moving, highly defensive sector.
It is. And it's a structural anomaly that tells us exactly what the institutional money managers are actually worried about.
Okay, walk you through that.
Real estate making new highs, while the broader market is just off its records, means smart money is quietly building defensive hedges.
Right, because real estate is a yield-bearing hard asset.
Exactly. It acts as a shield against inflation. So the surface headline says SpaceX goes to the moon, but the institutional positioning is saying, we are terrified of sticky domestic inflation.
And the Fed keeping interest rates higher for longer. They are locking in yield before next week's FOMC meeting.
They are completely ignoring the shiny object of the IPO and bracing for a harsh macroeconomic reality.
Speaking of harsh realities, we need to dive into the absolute tragedy that hit Adobe on Friday, ticker ADBE.
Yeah, that was brutal.
The contradiction here requires a deep explanation. On paper, Adobe reported a flawless Q2 on Thursday after the bell.
Flawless.
Record revenue of $6.62 billion, a huge EPS beat of 5.96 cents. They even raised their full-year guidance.
Right. By all traditional metrics, this stock should have soared.
Yet it plunged over 6.7% on Friday to multi-year lows around $203. How does a company post record numbers, raise guidance, and still get obliterated by the market?
It's the ultimate proof that the market is a forward-looking mechanism. It does not care about what you did yesterday. It cares about what your margins will look like tomorrow.
Right.
And Adobe was crushed by two converging fears. First, there was the sudden exit of their CFO, Dan Durn.
And he didn't just retire. He defected to Marvell Technology.
Yeah, exactly. A major semiconductor company. Executive flight is always a red flag, but the specific destination is what caused the panic here.
Right, going from SaaS to hardware.
Yeah, jumping from a software company to a hardware chip maker plays directly into a massive structural anxiety gripping Wall Street right now, the generative AI margin squeeze.
Let's break down the mechanics of that.
Yeah.
Why does generative AI hurt a software company that is actively implementing AI features?
Traditional software companies had incredible profit margins because once you build the code, it costs almost nothing to duplicate and sell it to millions of users.
True.
But generative AI changes the math completely. Every time a user types a prompt to generate an image, it requires massive computational power.
And that compute is incredibly expensive.
Exactly. So Adobe might be making money from the user, but they are turning around and handing a huge chunk of that revenue straight to the data centers and the semiconductor companies.
Like Marvell.
Like Marvell, the chip makers are selling the picks and shovels in the AI gold rush.
While the software companies are forced to offer these features just to stay competitive, essentially crushing their own future gross margins.
Precisely. So when the CFO looks at the books and decides to jump ship to the exact sector that is cannibalizing his company's profits,
Institutions don't wait around, they liquidate.
the numbers say, we are doing great right now, but the CFO leaving tells the smart money the structural growth is over.
That is a brutal repricing. So what does this all mean? Taking all of this in the geopolitics, the SpaceX liquidity drain, the defensive rotation, the SaaS repricing, how do you, as a trader, approach Monday's open? What's the day two play?
Let's start with the broad market, the S&P 500. Friday was a volatile consolidation. The critical support floor to watch is 7,237.
And if we break that level?
If 7,237 breaks, the technical mapping shows a potential rapid flush down to the 7,000 to 7,175 rate.
Clarify that for a second. The reports call that area a technical void. What actually is a void?
A technical void means there's very little historical trading volume in that specific price range. Because buyers and sellers haven't spent much time exchanging shares at those levels in the past, there is no established support to slow a fall.
So price just drops right through it.
Very quickly, yeah, until it finds a level where buyers historically stepped in.
What about the upside?
To be bullish, the index needs to break heavy overhead resistance at 7,500. But the highest probability setup for Monday is high-frequency chop. Expect a messy, range-bound open.
Makes sense. What about the elephant in the room, SPCX? Does the momentum continue?
Day two for a mega-cap IPO is purely about price discovery. The absolute pivot point to watch is $150, which was Friday's opening print.
Right.
If it holds $150 as support, day traders will look for a volume confirmation squeeze back up into the 170s.
And if it fails to hold?
If it breaks below $150, the initial euphoria is over. Expect profit taking to accelerate, pulling it back toward its 135 IPO price.
Got it. And for Adobe, the reports mentioned a mean reversion play.
Yeah, a mean reversion trade is based on the idea that an asset price will eventually return to its long-term average, the rubber band effect.
Right, and it's deeply oversold right now.
Exactly. The key psychological level is $200. If it stabilizes there, it could bounce sharply simply because the selling was so mathematically extreme.
But if $200 breaks on heavy volume...
Then the institutional flush is continuing. Stay away.
All right, we've covered the macro, the indices, the giants, but I want to close by analyzing one final bizarre detail from the reports. It involved Rocket Lab, ticker RKLB.
Oh, this is a fascinating setup.
Right. On Friday, Rocket Lab plummeted 10.8% down to $102.39. It was caught in that space stock shakeout.
Yeah, retail panic selling to fund their SpaceX FOMO.
Exactly. But the incredible part is that Rocket Lab just announced it is officially being included in the NASDAQ 100 index on June 22.
If we connect this to the bigger picture, this creates one of the most mechanically fascinating setups in modern trading. It is a forced buying arbitrage.
Break down the mechanics of passive index inclusion for us, because it seems insane that a stock dropping 10% right before joining a major index is actually a highly coveted long setup.
It all comes down to the legal mandate of passive index funds. When a stock is added to a major index like the NASDAQ 100, trillions of dollars in passive funds that track that index are legally required to own it.
So the fund manager doesn't get to look at Rocket Lab's 10% drop on Friday, analyze their balance sheet, and say, I think I'll pass on this one.
They cannot.
Oh.
By their own prospectus, if they do not hold the exact weighting of Rocket Lab dictated by the index, their fund fails to track the benchmark.
Wow.
They are structurally blindly forced to buy millions of shares of RKLB by June 22, regardless of its valuation. regardless of its fundamental performance.
And regardless of SpaceX entering the market, it is a wall of guaranteed money.
Exactly. And because retail traders artificially depressed Rocket Lab's price on Friday by dumping it for SpaceX, they have essentially handed institutions a massive discount on a stock that passive funds are about to blindly buy in bulk.
Which is why the reports call it an asymmetric long setup. The downside is structurally capped because there's a massive guaranteed buyer stepping in next week, but the upside is huge as that forced volume hits the tape.
Right. Active traders know this, so they buy the discounted shares today, specifically to sell them at a premium to the passive index funds next week.
That is the ultimate peek beneath the surface. To summarize the sheer scope of this single Friday, we had a market reacting to geopolitical whiplash, draining massive liquidity to fund the largest IPO in history, rotating capital defensively into cyclical and yield-bearing assets, and brutally punishing record earnings because of structural AI anxieties.
All while printing a serene green close.
Right. It is exactly why active traders cannot rely solely on the closing numbers. The edge is always found in the internals, the volume, and the divergences.
Could not agree more.
Which brings us to a final thought to take into Monday's open. Building on that Rocket Lab arbitrage, we have reached a point where a fundamentally sound company can lose over 10% of its value in a single day simply because retail traders have FOMO for a shiny new competitor.
Yeah.
But next week, massive passive index funds will be mechanically forced to buy millions of shares of that same company, completely blind to its actual value.
It's wild to think about.
It really is. We have to ask ourselves, are we reaching an era where stock prices no longer reflect a company's underlying fundamental reality? Are these prices simply the result of algorithmic plumbing dictating where the capital absolutely has to flow?
Right.
When you look at the market gliding across the tape next week, perfectly calm on the surface, are you watching the swan, or are you just watching the violent currents underneath pushing it around?
That is a vital perspective to keep in mind. We will see how the tape digests it all on Monday.
Thank you for joining us on this deep dive into the market internals. We'll see you for the next closing print.